As we scan across the major markets into Friday, there hasn't been much change since the weekly open. At the same time, the way things have played out is perhaps more interesting and meaningful given the flow of volatility throughout the week. Currencies had come into the week under pressure against the US dollar and had extended those declines in the first half of the week before finally finding support and rallying back in the aftermath of testimony from the Fed chair, in which he communicated there was no change to the central bank's outlook that was calling for additional rate cuts, despite what had been a stronger June NFP print. This triggered a reversal of flow in the FX market, opening the door for a renewed wave of dollar selling and currency demand. There was some cooling off of this dollar sell-off on Thursday after US CPI came in above forecast, though we don't believe this was anything more than some consolidation after aggressive selling of the buck post Wednesday's Powell testimony that had run into Thursday. Ultimately, it seems the message the Fed chair was looking to get across was a message that the Fed is still worried about fragility in the U.S. economy post-2008 crisis and is happy to look to reach for any excuse to lean to the accommodative side so that it can hopefully continue to prop investor sentiment and keep the record run in stocks going so everyone can feel good. If the Fed has a difficult time justifying rate cuts because the job market is looking better or inflation is picking up, it can either downplay the data or talk about the need to cut because of downside risks associated with the global growth outlook and U.S. trade policy. And U.S. trade policy could be the thing that ultimately dictates direction in financial markets in this second half of the year. If this is the case, the U.S. administration's trade policy should pressure the U.S. dollar lower. As far as the equity market goes, we continue to wonder how good investors can feel about rate cuts that can't be meaning all that much any longer. This leaves risk markets exposed to negative shocks from trade wars and could invite a pullback that is already well overdue. Looking at Friday's calendar, key standouts come in the form of China trade data, German wholesale prices, Eurozone industrial production, and U.S. producer prices. That's all for now.